Hi everyone, this is Dimitri Pragmatic with MarketChameleon.com. In this video, we're going to talk about market on close order imbalances. So the market on close orders are special order types, and they were created for really mostly institutions that need to trade on the closing price. And I'll give you an example for a mutual fund. A mutual fund doesn't trade like a stock at different prices all day. It only trades at the end of the day net asset value. So once a day, it trades at a net asset value. And for example, if during the day, the mutual fund receives lots more buy orders than sell orders, then they're going to have to create more shares. They're going to create more units. And to create more units, they have to buy at the closing price to get that closing and net asset value. And so what they'll do is send buy on close orders to get those executions. And when there's a lot more buy orders than sell orders that are going to the specialist, what will happen is there'll be an imbalance. And if there's an imbalance of over 50,000 shares or more, there'll be an indicator of a closing order imbalance, either to the buy side or sell side. And what this does is kind of gives you a view of how's money flown into these types of institutions. It can be mutual fund, certain ETFs that trade on the NAV, maybe some hedge funds that trade on closing net asset value. So what you kind of get is a picture of, are there more buyers flown into certain sector stocks, mutual funds, or flown out? And this here is an example of the buy order imbalance. It'll get printed on tape at 3:50 p.m. The idea is that it gets an indicator. So if there's a huge buy order imbalance, it gives an indicator for someone who possibly might be looking to sell a big block of shares, and this gives them a chance to match up. And if not, then he'll just get, the specialist will execute against his book. So over here, they get printed at 3:50 p.m. Gives it 10 minutes before the close to get all those orders, closing orders matched up. So here, for example, this is in ABBV. There's buy order imbalance of 337,400 shares, which is over $23 million in notional value that needed to get bought on the close, and this was the closing price at the end of the day. Over here, up top, we see day by day in aggregate. So on this day, you could see much more buy imbalance than a sell imbalance. 900 million versus almost 400 million. The day before, 900 million versus about 100 million, and so forth, going down the line. Now, let's say you wanted to kind of paint yourself a picture. How's it been going? How's the flow been lately? So go over here in the order imbalance screen, and this gives you a visual of, in the green, much more buy order imbalances. In the red, it's sell, and this is a 20-day moving average. So you could get a picture of how the money has been flowing into the entire market over here. And you could see here the daily amount, the net daily amount. So this is net daily inflow or outflow. This is the 20-day moving average of the net inflow outflow. If you wanted to look for just, for example, the S&P 500, you could change that and look how it's flowing into the S&P 500, Dow Jones, or any of these sector ETFs. So here would be the Dow Jones. You could see some spikes here, inflows. If you wanted to just create your own basket and in your watch list and just monitor how the inflows or outflows have been in stocks in your watch list, you could do that as well, or by market cap, and then you could just download this this table over here. So this is how the market on close order imbalances are printed on the tape at the end of the day. Thanks for watching, guys, and see you next video. Bye.